Today I'm going to be discussing the difference between private money lending and commercial syndications. So as many of you know, our old business model used to be fix and flipping houses. So what we did is we raised about $4 million from a group of private investors, friends and family, different investors throughout the country. How they would do that is they were the mortgage holder on the property. So instead of us going to a bank, like a traditional bank or hard money lender, we used private money lenders as both first and second lien positions on those properties. We secured their money with that mortgage and the promissory note, and then we paid them a certain percentage return on their investment. So typically we're paying between 8 and 12% annually. We're making either monthly interest-only payments or balloon payments at the end. There's generally a balloon payment at the end. It just makes it easier accounting-wise for us within that business model. But as you know, we've evolved into the commercial real estate space. So what I wanted to do is talk to all of those investors who are currently private money lenders or hard money lenders and show them a little bit of the differences between what we're doing now and what we were doing. We made the shift into the multifamily, self-storage, the commercial real estate space because it has better opportunities, not only for us, but for our clients. And the investors that we work with earn better returns in the multifamily space than they would ever on the single family space. So I'm just gonna go over some of those differences right now. So first of all, private money lending, also known as PML, there's no cash flow. So if we are not paying interest only every month, there's no cash flow. Even if we are paying interest only, that's not really cash flow. That's just your return on investment. That's not the cash every month that the property is generating, because the property is not generating any cash. The property is only a debt play. So you're only debt on the property. You have no equity. You are the leverage. You're the bank. So you're what we leverage. So if we needed $500,000 for a renovation, for the purchase and renovation of a property, we would borrow $400,000 from one investor and $100,000 from another investor, and maybe have 10 to 20 grand of our own money into the deal. Those investors were the bank. They are the leverage. So they're not able to leverage up into larger assets. See, today with this $500,000, we know that we could go out and buy anywhere from a $1.5 to a $2 million piece of real estate and get leverage from the bank and not use our private investors' money as leverage. Next, there's no equity in the deal. As I was talking about earlier, you're not an equity partner in the deal, you are a lender, you're a bank. Meaning that if we default on the payments or something goes wrong with the property, you can then go foreclose on us as the private money lender, and you would then in turn get the property. So you are the bank in the deal, you're not an equity partner. So there's a major difference there. Next, it's highly taxed. So say we were paying a 10% return annually. Well, that was great. And if we flipped the house in under a year, unfortunately, our investors were paying short-term capital gains. And if it was longer than a year, they were paying long-term capital gains. So although still capital gains taxes, these taxes that they were getting are extremely high compared to what the tax benefits are on a commercial syndication. Also, you're a 1099 investor. So you're getting a 1099 at the end of the year. Like I just discussed, the short-term capital gains are awful, 30 to 40%. So if you made 10, you might actually have only made 6, which is still a good return. Obviously, as you can see here, pre-tax returns for the private money lending situation are generally capped at 8 to 12%, just a bit different. So now when we move into the commercial syndications, the first thing you're going to see is this cash flow. And one of the things I notice is it's tax-free. With commercial real estate, say you were to invest $500,000 into a syndication, all of the cash flow you receive in that syndication up to your initial $500,000 is tax-free. So how that works is the IRS looks at this as a return of investment rather than a return on investment. Until you recoup that initial $500,000, you're not getting taxed on any of the income this property is producing for you as the passive investor in the deal. The next, as I discussed earlier, is leverage. Your $500,000 investment allows us to buy a $2 million asset. And with the equity splits how they are, you would own about anywhere from 70 to 80% of the asset, and we would own 20 to 30% of the asset. So it completely flips the script. Because with private money lending, you are the bank and I own 100% of the deal. Now, you are an equity partner with us and you own 70 to 80% of the deal. Obviously, a huge play is the equity appreciation. So we can force the appreciation in multifamily by raising the rents. So as you've seen in my previous videos, When we raise the rent, say $300 a month across a 320 unit portfolio, we're creating about $28 million of value at a 4 cap. What we would do there is then get new leverage on that new value. Say we would get a 70% loan to value on the new value of the building, and then we would pull out $20 million of tax-free money because debt is not taxed. So the equity appreciation is the major payday for us as multifamily syndicators and you as passive investors in the deal. Because we all get paid based on the valuation of the building, which is from forced appreciation by us raising rents, decreasing expenses, increasing income streams of the building with other incomes such as valet trash, premium parking, utility bill backs, internet package services, all sorts of different amenities that we can add to these buildings to increase the income and reduce the expenses. One of the major things we do initially is the sustainability side. So we are putting in low flow toilets, low flow faucets, we're changing light fixtures to LEDs to be more energy efficient. So that's where we can get our equity appreciation and then get new leverage and increase the value of this building and pull out that tax-free money. The next, as we talked about, is the tax advantages. So instead of being a 1099 investor, you actually get a K1 as owner of the LLC. So on the deal level, there's the LLC, and then there's the general partners and the limited partners below that. And all of us own the LLC. So the 70-30 split, that's 70% the limited partners own, that's ownership shares in the entity. So you own the LLC, you own a percentage of that LLC, and you get a K1 at the end of the year. What that allows you to do is if you're a real estate professional, meaning that you spend 750 hours a year plus on real estate, you or your spouse spend 750 hours plus a year on real estate, you get to pass through the tax deductions to your personal income. So that offsets your W-2. The best part about these are when we're done with the forced appreciation and we're stabilized and we've got our new debt, when we go to exit this property, we can do what's called a like-kind exchange or a 1031 exchange. And that allows us to sell the property and defer those taxes as long as we're able to get into a new property within the select time frame. So say we sell the building, we make $20 million, we then roll that investment over into a new deal and we do not pay taxes on that gain. It gets deferred until we sell the new building. So it's called a like-kind exchange. And the returns in these are generally anywhere from 15 to 20% plus annualized. The difference is this is 3, 6, 9, 12 months at most. This is anywhere from 3 to 7 years. So it's a longer term investment. You're in one deal. You don't have to really worry about it. You don't have to continuously fill out new loan docs and deal with the attorneys and closing costs and all those different fees that you may pay as a lender or as the investor on the deal. You're in the deal for anywhere from 3 to 7 years. You're not continuously having to roll your money and see where you can put it and look for new deals and vet new investors. And if this guy doesn't have a new deal, now where do you put this money? Your money is locked in a property that's paying you passive income, tax-free, all while your equity is growing, and then we'll pull out leverage, return all of that capital, and then and only then do taxes start to come into play. So major differences from private money lending into that single family, that 1 to 4 unit space, compared to our commercial investments, we're buying anywhere from 100 plus units throughout the country. If you have any questions, feel free to shoot me a direct message or put it in the comments. Thanks everyone.